Alright, good morning everyone. Thank you for attending our webinar. We shall begin the webinar now. As you can see, we have a long list of company results to go through, so I'll try to go as fast as possible. Okay, so this is Richard speaking. First we'll go through sets. I won't go through every single number and every single bullet point, so I'll just try to summarize one key point for each of the companies that I'm going to talk about. So for sets, you can see the title of the report that we published last week is Stronger Associates and JVs Offset Operating Cost Pressures. I'll just go straight to the bullet points. So you can see that what's going on for sets right now is that the associates and JVs are contributing a larger proportion to the earnings compared to the EBIT. So look here, year on year, you can see that the associates has increased by 57%, whereas EBIT is lower, and so that's taking up a larger proportion of the bottom line. For the associates and JVs, overall volumes were up. So what these volumes are referring to is passengers handled, cargo handled, and meals produced. At the revenue line, food revenue was lower, mainly because of this TFK Corp, that's the subsidiary in Japan. For the EBIT wise, margin compression, that's due to higher license fees. This is from the cessation of the fee rebates. Fee rebates at Changi Airport since okay, sorry, hang on. Hello, can you all see the slide now? Okay, sorry about that. I think I'll start again. Okay, morning everyone. Thank you for attending our webinar. As you can see from the screen, we have a long list to go through, so I'll try to go as fast as I can. This is Richard speaking. So first up, we have SATS, where you can see is the title of the report that we published last week is Stronger Associates and JVs Offset Operating Cost Pressures. I'll not go through each and every number, just quickly go through the bullet points as fast as I can. So, but the key thing to note from the results is that the associates and JVs are contributing a larger proportion to the bottom line in relation to the EBIT level. So that's because of the company that, because SATS has been investing more in the joint ventures and creating new joint ventures. You can see here 57% growth in that line for this quarter. That's in spite of the lower EBIT. Overall volumes were up, so this is referring to passengers handled, cargo handled, and food volumes for the associates and JVs. For the revenue side, Food Solutions was lower. This was mainly from the TFK Corp. This is the Japanese subsidiary in Tokyo Airport where it has their in-flight kitchen. Meal volumes were weaker there. For the EBIT side, there's a margin compression from higher license fees. This was due to the cessation of the fee rebates at Changi Airport since 1st of April this year. So overall, there's a stable to positive outlook for SATS. EPS growth that will come from the associates and JVs there's a horizontal integration and vertical integration. So horizontal integration refers to existing businesses in new geographies, and then vertical integration is such as the DFAST SETS joint venture, where they deliver the in-flight duty-free to the passenger's home. The more exciting thing is these two joint ventures here. That's what the market was excited about last week, and that's why you can see the share price went up last Friday. First is the AirAsia ground handling JV. So there's kind of a equity swap with AirAsia for the ground handling site at Terminal 4 and for Malaysia. So after all the equity swap, the effectively SETS will retain a 60% stake in the ground handling of Terminal 4 Singapore, and in exchange they'll get a 49% stake in AirAsia's total Malaysia ground handling. So for Terminal 4, it only has a capacity of 16 million passengers, whereas for the whole of Malaysia, the 15 airports where AirAsia is operating at, there's a capacity of 88 million passengers. So you can see the big difference in the numbers. And currently, this AirAsia ground handling unit only serves AirAsia, but when SETS comes in, SETS will try to market the service to other airlines and capture more market share. The other one is the in-flight catering joint venture with Turkish Airlines. This is at the Istanbul new airport, which is currently under construction, and is slated to become the biggest airport in the world. First stage of the airport will have a handling capacity of 90 million passengers, and when it's fully constructed, there will be capacity for 150 million passengers. So SETS will have a 50% stake in this in-flight catering JV with Turkish Airlines, and Turkish Airlines has got a 70% market share in Istanbul. So you can see the reasons why the market is excited about these two JVs. For the AirAsia JV, it will be completed sometime probably by the end of this year, and it will start to be accretive to the earnings straight away, whereas for Turkish one, it will take some time because the airport is still under construction, so that's a bit further out in the future. The other one is ComfortDelGro, so strong cash generation, absolute dividend level sustainable. We are maintaining buy for ComfortDelGro. There's an improved profitability at SBS Transit, and it's making an impact to ComfortDelGro. So SBS Transit is 75% owned by ComfortDelGro, and this quarter it has contributed 10.4% to ComfortDelGro's bottom line, and that's compared to 6.7% last year. So this actually is mainly due to SBS 42% increase in the profit, and to a lesser extent the decrease in ComfortDelGro's profit. And for second bullet point here, despite the lower profit, the cash flow has actually improved. That's because of the lower taxi capex. So for first 9 months of this year, the profit after tax for ComfortDelGro is 5.1% lower, but actually the free cash flow is 29% higher. And so for that, we believe that the absolute dividend level should be sustainable. And at last year's dividend level, that will give you about 5.2% yield compared to the historical 3+% yield. Of course, the Singapore taxi business continues to be challenged. Taxi fleet has shrunk 4.7% quarter-on-quarter and 12% year-on-year. Idle rate also 4.5% compared to 5% in the previous quarter. But overall, the taxi business is becoming a smaller part of ComfortDelGro already, as SBS Transit increases its profit level. So for one of the negative things for ComfortDelGro is the effective 2.2% fare reduction that's starting 29 December this year. This will delay the break-even for downtown line to sometime in the early 2019 compared to the previous estimate of late or second half of 2018. Take note that this fare reduction only affects the Northeast Line and Downtown Line and does not affect the bus business because the bus has already transitioned to the government contracting model. Overall, we have a positive outlook for it. That's from contribution from Downtown Line, and also next year SBS Transit will be taking over the Seletar bus package. Next, we move on to 800 Super. Results were stable. You can see revenue flat, PATMI also slightly lower, but only 2.5% lower year on year. The key highlight is that the waste to energy plant has already obtained its TOP and will undergo the testing and commissioning by the end of this year. The other big project, the sludge treatment facility, is on track for completion in second quarter of next year. Some pressure on margin. The OPEX was higher, led by higher staff costs and other expenses. But overall, we are still having a stable outlook for 800 Super, and there's room for a positive surprise. Positive surprise may come from winning the Pasir Ris Bedok public waste collection contract. They had put in the lowest bid at 194 million. Outlook for dividend as well should remain sustainable at 4 cents, same as last year, because operating cash flow should remain stable as well. Next is SIA Engineering. Muted outlook with absence of near-term catalysts. First up, interim dividend is 4 cents. That's unchanged from last year. However, we are not confident of them maintaining the same full year dividend as last year, and we have already cut our dividend estimate. Next bullet point, market share at Changi Airport remains largely intact. So they hand out 3.8% more flights in the first half of this year. That's roughly in line with the same 4.1% growth in flights handled in the whole of Changi Airport. Associates and JVs this quarter was higher, 33% higher, and it helped to offset the lower EBIT. So historically, EBIT was a larger contributor than associates and JV to the bottom line, but now that has swapped around. You can see here, associates is actually contributing more than the EBIT to the bottom line now. For associates and JV, is actually the same story as with the previous quarters, that associates have been higher because of lower fuel cost has prompted the airlines not to scrap the older fleets, and they are using the older engine. That's the PW4000, and that's handled by Eagle Services. What's new in this quarter is that in the past, management has said that associates contribution should taper off once these engines are brought out of service. But what's new in this quarter that they're saying is that this associates contribution should remain stable, as after that it will transition to the other engine as well. That's on the A320. For the JV, that's a Cecil, which does the Rolls-Royce engines. No change from previous quarters. So the outlook remains challenging, and we don't see any near-term catalyst. Margins continue to compress despite the higher PATMI, and the PATMI was also lower than expected. even though it's higher. So that's why we have revised our PATMI forecast downwards and also lowered our dividend assumptions. Okay, we move on to property sector now.
Alright, good morning guys, this is Hong here. We have a host of developer results last week, so I will start off with CapitaLand. CapitaLand, there was a recovery in office and hospitality segments. We will go on to the numbers first. For gross revenue, it was up almost 10%. This quarter, they had to do a consolidation of the revenue from CMT, CRCT, and RCST. And gross profit was up 20%. As a result of higher gross margins from rental revenue. And overall, operating PATMI was down because of a lower handover of residential projects in China. On the operation front, we see that sales momentum for the residential properties, especially in Singapore and Vietnam, has been sustained and is still pretty strong. But you see that in Singapore, the residential sales was down 29% year on year, but that has got nothing to do with slowing momentum. In fact, momentum is still there, but this down 29% year on year is more of a factor of CapitaLand having very limited remaining inventory available for sale. We all know that CapitaLand, if you were to talk about being a proxy to the current upcycle in the Singapore residential market, they are one of those with the more limited inventory. So that was one of the factors for that drop. But for Vietnam, it is still showing very strong signs of momentum. The more negative part is in China. China has had launches was slower, but they still managed to sell 90% of the units they launched. And going forward, launches are expected to remain muted as well, with the cooling measures ongoing. And for the office markets in Singapore and China, they have showed signs of improvement for the portfolio. Entire portfolio occupancy is at 98%, and this is actually a market improvement from FY16 where it was at 90%. So on the hospitality front, you see that the RevPALs, which is revenue per available unit for the service residents, is actually seeing recovery, especially in the key markets for CapitaLand. There are three biggest markets, which is number one, Southeast Asia and Australia, number two, China, and then number three, Europe. These regions are all showing strong signs of growth. Growth in the RevPAL was between 1 to 12% in local currency terms. And this is particularly significant because for especially China and Europe, in FY16, they were actually doing year-on-year declines. So now you're seeing a sustained recovery there. For the negative side of the hospitality arm, you see that Singapore and the Gulf region were weak. But then these were not as significant because these two regions are actually not as huge for Ascott and CapitaLand. These two regions only constitute less than 8% of total units that they have. So for CapitaLand, in summary, we have an accumulate call, maintain accumulate. Our target price is unchanged at 419. Okay, for them, sorry, I forgot to talk about this point about tenant sales growth for Singapore malls. That aspect has been pretty muted. same store sales is flat year on year. But the bright side on this is that for China tenant sales growth, which has been dropping over the years, they look to be stabilizing in a mid-single digit. So like I mentioned, our maintain accumulate for this is as a function of them having a very strong base of recurring income. You see that 85% of total assets that they have now are contributing to recurring income, which means they are more of investment properties rather than development properties. And CapitaLand is really a play in Singapore and China. So like we saw in the news this morning as well, they just opened one of the largest mall that they have in their portfolio in Suzhou. That is almost like a 3 million square feet worth of a mall, 3 times the size of Ion. And this year itself, they have more than 1 million square meters of launch of new retail space, and that is actually like 10% of the entire what they had before this. So gradually, as this launched retail space, all these integrated developments, they start to ramp up occupancy. I think you will see that over the next few years, these new launches this year will start to bear fruit and start contributing to the growth of the recurring income for CapitaLand. And so on top of the strong base of recurring income, they also engaged in new asset-light management strategies, management contract strategies. It was the case for Ascot, and then last year they announced it for Capital Mall as well. So for shopping malls to engage the same kind of management contract strategies, and these strategies will enable them to grow and scale up without having the heavy capex expenditure. So I move on to Hobby. Hobby had a largely stable set of results. We all know that their portfolio is actually very stable, like CapitaLand. For numbers first, we touch on the you see that year on year, because there were less sales recognition of 2 projects in Australia, that led to a drop in development properties revenue. And for rental income was pretty stripping out the contribution from the new acquisition, rental income was pretty flat. And associates and JV revenue jumped because there was a greater handover of residential projects in Shanghai and Tangshan. So all in, you see that net profit actually doubled. For operational wise, in China, we all know about the cooling measures. Now the sales momentum has been pretty on par with what they sold in 2Q. It is still slow, but the good thing is that despite the slowing transaction volumes, you see that the prices are still holding up. Like for example, in their largest project in China, Yanlot Western Garden, the selling price now is at a 60,000 RMB per square meters. That is up 13% from the start of the year. And from what we hear a lot on the ground is that transaction volumes are falling because a lot of developers, they are holding on to the inventory because they want to, in China, if you need to up your selling price, you have to get a separate approval from the government. And since that is not possible now, and they think that the selling prices can be higher than now, they're actually holding back inventory. Actually a lot like what is happening in Singapore now, in that you see, like for instance, there was news about CapitaLand holding back their inventory so that they can participate in a greater upside they foresee next year. CityDev as well. You saw the case for Park Botania as well. So it's actually a pretty similar case that developers are facing in China as well. And for Hobby, the office portfolio, there are 2 parts, one in Singapore, a lot in London as well. and the portfolio in Singapore, which constitutes which is constituted mainly by the metropolis at Buona Vista. This is a Grade A suburban office tower. This takes up about 40% of Hobie's total gross asset value. This price asset is very stable. It is still at 100% occupancy, going into its second rent renewal cycle since opening operation in 2013. So Singapore side is stable. London side, you see that the leases are all very, very long, 5 to 10 year leases with built-in rental escalation. So that aspect is stable as well. And so that brings us to our last segment for Hobie, which is one of the segments that is pulling them down as well. That is the residential condominiums they have in Sentosa. They have 3 blocks down there currently up for rental because of the slow market there. Rental occupancy is currently at about 80%, a slight increase from last quarter. But what we note is that you see that this year, along with the increase in transaction volumes and prices for mass market houses in Singapore, in the high-end segment, in the core CCR property transaction volumes and prices have picked up this year as well. However, this is not yet translating to the Sentosa condominium market, even though you see that bungalows in Sentosa, they're actually selling there's also an increase in transaction volumes as well this year. It's actually one of the highest volume over the last easily 5 years. So what we think is that for this, the interest and transaction volumes will gradually return to the overall high-end market because of a few factors. There's a lack of supply currently in the CCR region. And then secondly, you see that there is increasing cooling measures implemented in other countries now. And the price appreciation for high-end properties in these other countries has led to a widening gap between the properties in those countries versus the properties in the high-end properties in Singapore. For example, you see that Sentosa condos have fallen 50%, close to 50% from their peak. So there's a widening gap between the other top cities and Singapore. And then there is also a narrowing gap between Singapore's mass market housing and high-end housing. So all these various factors lead us to believe that eventually the sentiment will cascade down to the high-end market, and when that happens, you see that the Hobie's discount to book will actually narrow. The last transacted prices for Sentosa condos are actually pretty is like a 1,500 kind of level. That's a very far cry from the 3,000 plus 4,000 they were able to do at their peak. So we maintain our accumulate with an unchanged target price of 298. The key thesis for Hobie is that it's one of the heaviest discounted large cap, I mean more than 1 billion, developer in Singapore at 42% discount to book. This is despite them having a strong recurring income base of properties at 66% of GAV. This recurring income actually is able to cover almost 4 times what they are paying out in dividends this year. So as mentioned, as interest and transaction volumes gradually return to the high-end market in Singapore, we expect this discount to book to narrow. Okay, next we have CityDev, a pretty strong set of results, strong performance across most of the segments. For on the numbers end, property development revenue was down, but that is primarily because last year the same time they had a few EC projects TOPing. We all know that the revenue recognition policy for EC projects is that they have to be recognized all upon TOP. This is a bit different from the normal Singapore residential market properties where revenue is recognized as a percentage of completion. So that will lead to a bit of lumpiness in the revenue recognition, and that is what happened. So hotel operation side is improved, led by recovery in RevPARs globally. And at the bottom line, excluding one-off divestment gains, year-to-date PATMI actually increased 4%. Operationally, as with the case we've seen in other developers, momentum in the Singapore residential market is still strong. The value of all the units that they have sold in Singapore this year has tripled in value year to date, tripled in value to 1.8 billion. Number of units sold was double year to date when value was triple. So you see that actually there's actually a bigger proportion of higher end units sold, and you see that in the sales figures for Gramercy Park. At the start of this year, there was still a lot of uncertainty over that project, whether you'll be subject to all the extension charges and all, but right now momentum has returned. And going forward, what is due for CapitaLand in Singapore is that they will have 4 projects due for launches, but in the near term, you see that 3 of them are due for 1H 18. First one is New Futura, that is a CCR project at Leonie Hill. Second one is the Tampines site that they won this year. The third one is South Beach Residences. So I go on to talk about hotels first. Hotels, as I mentioned in the numbers just now, the growth was led by an improvement in global RevPARs. On a like-for-like basis, MNC's global RevPAR improved 2%. There was strong growth in Australasia, London, and New York. And these 3 markets make up 40% of MNC's FY16 revenue. For residential sales in UK and China, same story as well. Sales are slower. There's a lot of uncertainties in these countries right now. There's over Brexit, and then there's government cooling measures as well. So in these countries there was slow momentum. But one thing to note is that they announced this strategic partnership with Vanke in the last quarter, and this is done through a partial divestment of 2 projects that they have in Chongqing, the Chongqing Huanghua Yuan and the Yiling Residences. So they divested 70% and 50% respectively of these 2 projects to Vanke. Good thing about this is that firstly, instant monetization of the assets. You allow for capital recycling. So they got about 1 billion RMB from these 2 projects. Secondly is that they are able now to tap on Vanke's the extensive local networks and development expertise, which we think that could actually lead to increased future saleability for the 2 projects. For CDL, our call maintains at accumulate. Target price is unchanged at 12.10, and the reason is still an accumulate is because of this ongoing potential offer for MNC. We saw that they announced the potential first offer was at 552 pence. So upon successful acquisition of MNC, that will actually be accretive, and that could actually increase our target price to a high of 13.50, but actually that of course depends on the final offer price that they have for MNC. Of course, we expect the final target price, if any, which is to be announced by the 8th of December, the final offer price would likely be a much improved offer price from the previous 552 pence, because right now the current trading price is already a 10% premium to the old offer price. So depending on the offer price, the final offer price, which we will update in due time, our target price could potentially increase to 13.50. So for CapitaLand, the selling thesis is that they remain one of the one of the most well-stocked developer under our coverage. They have a large exposure of unlaunched land bank and also available for sale inventory to enable them to capture the potential upswing in the Singapore property prices. So a catalyst for them going forward will be a successful launch for the 3+3 projects in 1H 18 and the Amber Park site in 2019. For the 3 projects in 2018, we are pretty confident of the execution. The 3 projects, New Futura, there is a shortage of supply in the area. You look at the take-up rate for projects in the vicinity, the healthy take-up rates for the newly launched Martin Modern this year, and the increased interest in Gramercy Park, which is actually very near to New Futura. These will actually point to the potential healthy take-up rate for New Futura. And also, like we mentioned, there's a very severe shortage of new land in the CCR region. Martin Modern was one of the only land sites in CCR sold by the government over the last few years. So you know that over the next few years, launches in the area will be very scarce. For South Beach, I think it's a no-brainer because of the location that they're occupying in the central area. And for Tampines Avenue 10, I think the forecasted launch price by our estimates at around 1,001 PSF. The trend now, I think, is going towards very smaller units. You have increasing PSFs, but this is buffered by the fact that units are getting smaller as well. So quantums will remain affordable. We have seen that in a lot of suburban regions like Tanah Merah, for example. These suburban areas, you have launches at the 1,300 range, and the take-up rate was equally strong as well. So I think there is this mental anchor in investors' mind that suburban prices 1,001, 1,002 is already the norm. You see that in the last weekend, the Sengkang launch for Park Botania, average launch price was 1,270, and the sell-through rate was very high at 70%. So I think for CDL's Tampines site at 1,001 PSF, it is there's a high chance that they will be able to execute this very well. So for CDL, like mentioned, the large land bank and available for sale inventory makes them a very Singapore play. Post consolidation, if successful, of MNC, SG Residential will still make up 31% of the total GAV. And if you add in all the offices, retail, all other assets in Singapore, Singapore will still occupy a 56% of total GAV. Okay, next we move on to Banyan Tree. Banyan Tree's improvement in revenue was mainly driven by better or higher recognition revenue from property sales. They had units sold in KSIA Bintan, which were recognized in a quarter. Hotel investments was down though, and this was because Maldives was particularly weak in the quarter, and Thailand and Seychelles were stronger, but those were not enough to offset the weaker Maldives. For operational updates, we have it that for Banyan Tree's biggest market in Thailand, which actually gave them 60% of last year's revenue, that region is growing very strongly. 3Q17 RevPAR was up 10%, and this is a continuation of the trend since the first 2 quarters of the year. And okay, for property sales, in the quarter, they sold units which had a value of 2.5x year-on-year, and this was also mainly from the sales of units in KSIA Bintan. For one of the negative things in the quarter was that operating expenses actually increased higher than our expectations, and that actually hurt EBITDA margins. The higher operating expenses were as a result of higher exchange losses from the depreciation of the US dollar and higher provision of bonuses and incentives. Maldives, as mentioned, was weak. RevPAR drop is scary at 33% down, but this is expected to ease in FY18. And for Maldives, you see that this year across the board, you look at CDLHT's Maldives properties as well, they were hit as well because generally in the country, supply is very high this year. There's a 15% growth in industry operational hotel beds. So even though this year tourist numbers for Maldives was recovering as well, but that was not enough to offset the 15% growth in total beds. But why do we say that it is expected to ease or improve in FY18? FY18 supply will still be quite a bit, 8.2%, but you see that it will start to taper off after this year. From a 15% this year, next year 8%, FY19 even lesser. And what I think is happening in Maldives is that there's a lot of initiatives on the tourism front to boost tourism numbers, and including one of these upgrade to their international airport, which is expected to increase their capacity from 1.5 million passengers to almost 7 million passengers. So what you're seeing now is a function of government trying to increase the supply in anticipation of the future expansion in the tourism sector. So I think the pain will always be the pain will always be the strongest at the start when your supply is at the max. So this year you see that supply is really huge, 15%, but afterwards it will start to taper off, and it is really a function of growing supply in anticipation of better things to come for the sector. So all in all, since our initiation prices have gone up a bit, and with the downgrading of the target price as well, this has brought our potential gains to less than 20%. That explains our downgrade from buy to accumulate. So the downgrade in price target is primarily because of the lowering of EBITDA margins for FY17 to 8%. For outlook, we expect RevPAR strength in Thailand to sustain given the low base from last year. We know that the Thai king passed away in October last year. After that, the few quarters after that, you have this impact to tourism. So from now on, at least you still have a few quarters of a low base for RevPAR to see for it to effect a year-on-year growth in earnings. Maldives should improve in FY18 as mentioned, and I think Banyan will really be a play on the two partnerships they signed early this year with Accor and Vanker in terms of the management contract opportunities that they can get, which will enable them to scale up at a totally different pace from last time without having to dish out the heavy capex that they have typically been doing. So this story will be very highly dependent on the pace of the management contracts that will flow through from Vanker and Accor. And now for our last company update, Eng Seng. Eng Seng is riding the Singapore property cycle very well. A bit on the numbers first. Revenue up 40%, but primarily driven by the fact that this is the first quarter that they are recognizing revenue from Grandeur Park, the condo beside Tanah Merah MRT, launched earlier this year. It is doing very well. Currently, it's already 82% sold with just 6 months of launch. So this is the first quarter of revenue recognition from that project. And then you have the miscellaneous, the ongoing projects in Hyde Park, in Fulcrum, and in the Melbourne projects as well. So all in, that led to the growth in the property development revenue. Construction was a bit down, but Okay, outlook, we will touch on that later. Hospitality is up from because of this new project that they opened in Maldives, and then in Park Hotel Alexandra as well. There was improved occupancy in the 80 odd percent currently. This is an improvement from FY16, which was doing around mid 70s percent. And we all know that this year in Singapore tourist numbers were better. And for Park Alexandra, more than 50% of demand is coming from corporate demand as well. So improving corporate demand actually helped as well. So for Eng Seng, one of the potential catalysts is also, we all saw in the news about this project they have in Melbourne, the Melbourne Tower, in which they cancelled all the purchase contracts with buyers just a few weeks ago. And this is as a result of this legal proceedings that they had with this owner of this adjoining property. So in Australia, they have this sunset clause whereby failure by the developer to uh, produce the finished product within a certain time frame will lead to the sellers or the buyers having the right to cancel the project, cancel the contracts. And that is what is happening to Eng Seng now. Because of the ongoing legal suit, they are unable to finish, they are unable even to do the demolition works on this project. So needless to say, construction is still not yet started. So contracts are cancelled, but right now we see that there has been some resolution to the ongoing legal spat. The owner has actually, there seems to be plans between the two owners to co-sell, to jointly sell their plots of land as one big plot of land. So the monetization plans for Eng Seng, any successful plans out of these discussions could be a potential catalyst for an upgrade to target price, because we know that for the original contracts that they signed, those were sold between 2012 to 13. Those contracts between that time and now, property prices in the area has gone up close to 50%. So there's a chance that they might be able to get higher selling prices right now with these new market prices in the vicinity. For Eng Seng, we had a buy call previously. Our call now is still a maintain at a buy, but our target price is improved from 90 cents to 120, and this is a function of a few factors. Firstly, we narrowed our discount to RNAV. Previously, we were using a 50%. Now we're using a 40%, and the discount is as a function of what we think is we are entering this upcycle in the Singapore residential market. And secondly, we also incorporated valuations of the group's construction business. Previously, we took a conservative approach and we did not factor in a single cent contribution from that segment. And the reason for that previously was because in the last few years, construction sector was in the doldrums. Right now, we believe that we are nearing the bottom of the sector. You see that the government is actually throwing in a lot of help for the sector. A few months ago, they announced a bringing forward of 700 million worth of contracts, and this is already on top of what they have announced in a budget earlier this year of another 700 million. And to add to this public demand, there's also a potential increase in the private sector as well. So because of this improvement in the outlook for the construction business, we have now incorporated the valuation of that. And so the RNAV boost for Eng Seng could come from a favorable monetization of Tower Melbourne, as I mentioned previously, and also strong take-up rates at this Woodley site that they are due to launch in the second half of 1/8. That one will have an estimated GDV of 720 million. So this will be a summary page of the peer comparison table and the counters under our coverage. You can refer to this from our developers reports, or you can get it from our stocks BNB. With that, I'll pass on to Lin Sin for the consumer sector.
Hi everyone, this is Lin Sin. So sorry that Jeremy is out of office today. So I'll just reiterate the call that that he has on DBS as well as Centurion. So for DBS, he maintained a buy call with higher target price at $26.83. As for Centurion, he has maintained an accumulate call with the same target price at 59 cents. Okay, so without further ado, let's move on to Singapore ONG. Sorry. So for Singapore ONG, as you can see that cancer-related segment is holding up strong. And as for dermatology, there's a stronger local patient load. They've been seeing some recovery in Singapore patient coming back, which offset the stagnant foreign patients. As for the ONG segment, we have been seeing the gynecology segment coming down in the third quarter. This actually weighed on a bit for the 9 months contribution. But we do take comfort that obstetrics segment is recovering. And if you look at the year-to-date Singapore birth rate, it actually went down about 5%. But for Singapore ONG, the number of deliveries just went down about 2%. So in that sense, if you compare year-on-year basis, their market share actually improved. But if you compare the year-to-date market share, which is at 4.2%, is the same as the full year of 2016. So we are optimistic that SOG would continue to maintain their market share at about 4% for this year. Although that we are seeing that the Singapore's birth rate has been coming down a bit. And do note that the negative effect coming from the Zika in which came in September, around September last year, should slowly taper off by now. And by then, with that, I would like to bring you back to the cancer-related segment, which the profitability continue to improve. And we do think that this strong performance should continue in next year. And it should be able to cushion any soft coming market in the delivery segment. And another positive note is that they have contributed their the pediatric clinic, the fourth pillar, has started to contribute to the third quarter top line. And we should be seeing that the second clinic to come in Tiong Bahru by end of this month. And do note that this pediatric clinic the first one is actually currently at Parkway, where the top two gynecologists, the top two obstetricians are located at. So currently, all the patients are actually via internal referrals, and seeing that with the top two obstetricians helming in Parkway, it should be able to provide a very stable patient pipeline for the first clinic. And that, with that, we expect that the first clinic should be able to break even by first quarter next year and start to contribute to the bottom line by end of next year. Having said that, we remain upbeat for the overall performance of Singapore ONG, in the sense that they are able to deliver a very stable organic growth throughout their record. And management actually targets to add 2 new specialists into the group every year. So for next year, they're looking at adding 1 doctor to ONG segment and another one to dermatology. So so for Singapore ONG, we downgraded our rating from buy to accumulate with a slightly lower target price at 62 cents. With that, I'll move on to Fraser and Neave, FNN. Sorry. So for FNN, I believe that everyone was a bit hyped up for the Vinamilk second open bidding, which happened last Friday. But unfortunately, the stake sale was won by Jardines Cycle and Carriage. So, okay, sorry, shall not digress. Let's move on to the full year results for FNN. So for FNN, we continue to see that the risk remain strong and provide cushion for the slowdown in beverage and the slower P&P segment. So for beverages, the challenges mainly came from Singapore as well as the Malaysian market. So what's happening in the Malaysia and Singapore market beverages segment is that we have been seeing that higher input prices, mainly from the sugar prices, because FNN they usually source their sugar needs from the government fixed contract, which priced it at slightly higher than market price at 2,800 per ton. And with this contract expected to expire by end of this year, FNN Group actually said that they are going to source at market price instead. So this actually will provide a more favorable prices to their input costs. So we should be able to see that the margin for Malaysia and Singapore beverages to improve. And for dairies, Thailand side continue to perform, and we are seeing the first contribution coming from Vinamilk as a share of profits of associates. And if you include the dividend income for the first half of for about the first half of the year, it actually contributed about 47% of the group's EBIT. So with that, do note that this table actually exclude the one-off exceptional items, which is the realization of fair value gains coming from the reclassification of Vinamilk from other investments to associated company. So the reval gain is actually amounting to about 1.2 B, but it's a one-off and non-cash item. It's just and there's no change in our book value as well. So we excluded that from this table. So in that sense, we are cautiously optimistic on Malaysia outlook, given that there's an upcoming elections which might dampen consumer sentiment as well as weaken ringgit against Sing dollar. But we do note that Singapore's consumer market has actually is showing signs of recovery. And just now, as mentioned by Teo Hong, the Thailand consumer market is also recovering post the Thai King's cremation, which happened last month. Oh, sorry. And for the printing and publishing as well, the losses actually narrowed post restructuring, and with the acquisition of the Penguin distribution and sales channel, it should be able to expand their sales channels, and that would likely improve their earnings next year. So with that, we upgraded our call to accumulate with a higher target price of $2.83. And for FNN, the next potential re-rating catalyst remains as the acquisition of additional Vinamilk via open market. So although that they failed on the second open bidding, we do not discount that they will be able to acquire more stakes in Vinamilk via open market. And the second one would be Sabeco's stake sales. The first tranche is expected to begin by end of this year. Nonetheless, market players or those companies who have actually announced their interest in participating in this bidding for Sabeco actually commented that Sabeco is actually quite pricey at the moment. If you look at the PE, the forward PE for Sabeco is actually at 39 times as compared to the peers average at 25 times. And if you compare against Vinamilk, which also enjoy a similar fast growth, they are currently priced at a forward PE of about 26 times. And our sum of the part derived target price implied a 27 times forward PE, which is actually 30% higher than the ASEAN peers at 21 times. We think that this is justifiable because a bulk of the earnings actually came from Vinamilk, and with the with the exposure to the fast-growing Vietnam dairy market, we think that 27 times forward PE is justifiable. So with that, I would like to end our webinar for today. And sorry, apart from the company's earnings, I would like to bring you guys to something that our team is excited and proud of, which is Stocks BNB. So if you can see that from here, on the top left corner, you can see the link to the Stocks BNB. So just click on it, or you can just type on your in Chrome or any Internet Explorer. Internet Explorer or what, www.stocksbnb. Then you come to this page. Sorry, to this main page, and you'll be able to find all our research reports which we have published. You can click on News and Reports, where it will be segregated according to the countries. And let me bring you through the recent strategy report, where I would like to show you a new feature that we have incorporated in the past week. So for example, if you look into the Phillip Singapore monthly November reports, so please do log in and join the discussion. You can actually but for the commentary segment, you can actually leave your comment without logging in, or subscribing. And we will reply to your comment. Yep. But of course, we do encourage you to sign up for the premium content. At the moment, is free of charge, and do note that because we are still upgrading the website, so you have to subscribe first. And for the Poems user, you'll be able to log in via Poems Poems account in future. And another feature that I would like to bring you through it would be talk to our analysts. So if you think that you have missed the chance to ask questions during the webinar, or you like, or probably you just like to get in touch with our analysts more personally, you can come to this page. But for this segment, you have to log in to create a new topics, and we would try to reply you ASAP. Let me go through. Yep. So just to let you take a look at what's inside the first topic. So you can continue the conversation here by clicking reply. Okay. So with that, I'd like to bring you guys back to the webinar. We'd like to open the floor to questions. Okay, there's a question on Singapore Energy. What's the forward EPS that derive the target price of 62 cents? So we arrive at 2.15 Singapore cents for our FY18 estimated EPS, pegged to 29 times of forward P. So yes, 29 times is actually the market cap average, market cap weighted average for the healthcare peers at the moment. We excluded IHH, which actually had a forward P of 55 times, an outlier, and 29 times is actually similar to or on par to Raffles Med at the moment. While Q&M actually has a higher P of 33 times. Nonetheless, as you know that Raffles Med prices has actually recovering, and we do note that the local patients in Singapore is actually turning around. So we maintain our forward P to be we maintain the forward P to be pegged at 29 times. Okay, there's a question that regarding Singapore Energy. Do you expect any inorganic growth for Singapore Energy? Heard that they have started an operation in KL. For the KL one, is actually is not that they have started the operation in KL. It's more of a collaboration with the KL Fertility and Gynecology Center. So they have signed this service agreement with this KL Fertility Center. This collaboration will actually enable Singapore Energy to offer assisted reproductive technology services, for example, IVF, in Singapore. So they will send the doctors over to KL for training, and this service is expected to commence in first quarter next year. So this is a new complementary services to its ONG segment. And if you'd like to know more about the collaboration and about the partner that they are working with, or more about the whole process and how the how are they going to capture the value chain, you can refer to the related reports on 5th of October. And if there's no more questions, I would like to urge you guys to please try out our Stock DNB website, and any feedbacks is welcome. We would like to serve you better. So with that, I would like to end the webinar for today. Thank you so much for your time, and please tune in next week.